got code section 162. We got code section 274. We have educational expenses under regulation 162-5, right? Once we did all the expenses, depreciation, right? And we spent virtually the entirety of looking at depreciation deductions. And with respect to depreciation deductions, there's certain you guys really have to know. So, Kyle, name one of the three things you need for depreciation deductions. Very loudly?
Yeah, convention.
Convention, right? And Maduka, can you tell us one of the four conventions? The most popular, if you don't mind me. Half-year convention, right? And you understand the poetic justice why Congress imposes the half-year convention, because most taxpayers will put some property into service at the beginning of the year, some taxpayers at the end of the year. So this is the government's way of striking a compromise, right? But if people decide to stuff property into service towards the end of the year, in this case, Galena, what do they use? 40%, right? I know I'm being picky, but that makes or breaks exams and CPA scores and things with your clients. So just be careful about that. All right? So
that's more than 40% in
last quarter.
Last quarter.
Right. And if you do, then all the property placed in service has to be put on a mid-quarter convention, right? And your numerators, Justin, are what? Just take in my sheet, your notes. 5, 7.5, 4.5, or 1.5, right? The numerators, and good news, the denominator set in stone at 12, right? Common mistake, though, is, remember, if it's on the mid-quarter convention going in, it's on the mid-quarter convention going out, right? And look at what quarter it's being sold in, right? And don't be fooled, because if it's being sold in December, don't think it's 1.5 over 12, it's 10.5 over 12, right? It's the flip. So we have two conventions, half year, mid-quarter. Nellie, do you have another convention? When do you use the full month convention? Say loudly, Nellie, so everyone can hear you. Whispering or mumbling? Intangibles. Right? For intangibles. Convention. Convention is for real property, right? This is buildings. So we have conventions. That's one of the elements you need to know. David, do you need to know something else?
The recovery period.
Recovery period, right? How do you know, Sherban, what's the recovery period? Burned out from this morning's exam. All right, better to be here, right? All right. Kyle, how do you know the recovery period?
You'd have to look at code section
168 says a lot, but where in particular? In other words, I will give you the class life. Once you know the class life, you can figure out the recovery period, right? Double declining balance, right? Everyone agree? Double declining balance. It's 15 or 20-year property. 150%. Is the 200% or 150% used for all property, Wendy? Just line all your ducks up. If you line up all your ducks, it's very mechanical. Very mechanical. Let's put it this way. Sometimes Congress wants to juice up the economy. How is that epitomized? Congress juicing up the economy? By 168K, which presently permits what? Expensing. Complete expensing. Even, and this is the strange thing that has never been seen before. It applies to both new and used equipment, both new and used. Usually Congress has restricted that in the past to to new, because they wanted people to purchase new equipment. It's weird that Congress now, I'm just checking with WebEx so you guys can see and hear me. I presume you can. But if you guys see anything to the contrary, let me know. All right, so we have Congress being magnanimous, giving us 168K, which in years to come, it gets phased out. You know, again, political parties are both guilty, Republicans and Democrats, get their agenda. So notice that many of the provisions expire in 2025 after the 2024 election. So in theory, if you're Republicans, this is good because then maybe people will say, gee, I want to keep the economy hot. So this tax benefit we're going to keep hot. Whether or not it really works is another question. I'm not going to try to answer. I mean, that's not my training. But I just notice the political dynamics of when you might have some of these sunset provisions. They're not as arbitrary as you might think. So we have 168K, Congress being magnanimous. You can elect out. You can elect out of Code Section 168K. Another benefit for small businesses epitomized by Code Section 179. Depreciation. Now, 179 for the time being will not be invoked. Why? Because 168K allows complete expensing, where Code Section 179 allows taxpayers up to $1 million of expensing. Place into service more than $2.5 million of property, they lose the ability to take deductions. But as I'm pointing out to you, right now 168K obviates the need for 179. And then we saw that sometimes, so those are both pro-taxpayer provisions, right? 168K, Code Section 179, designed in both instances to juice up the economy. Code Section 280F, so-called listed property, which Congress thought was suspect, right? That taxpayers might be over the top with respect to their deductions. And therefore, Section 280F, listed property, there's restrictions on what's deductible and what's not. And we saw that in the case of the luxury automobile. Now, again, because in my opinion, I want people to succeed and do well. Let's just take a simple problem and take the first 2 years of depreciation. You purchase what kind of asset, guys? Just remind ourselves that what kind of asset do you use in a trade or business? All right. And when you say 1231, Wendy, what code sections do you think of at the same time? Right? Wendy, what's your favorite number? Give me a number. Your favorite number? I'll go with it, but let's make it 5-year property, okay? You purchase a tractor for $1,000 per Wendy's instructions. What is the depreciation deduction in year 1 and year 2? Take 2 minutes. Obviously, I didn't prepare before class. I haven't computed the number. But come up with a number, guys. Pretend it's an exam, and Soled just said, hey, he picked his favorite number, whatever my favorite number might be du jour that day. You guys have to tell me, okay, I understand your question. We're going to elect that at 168K. Otherwise, we could deduct the full 1,000. So I like your question. Good question. But for exam purposes, just assume, well, in most questions, we'll say assume the election was made out of 168K. So I really want you to compute depreciation deductions. And 168K does not apply to real estate. Some examples pertaining to real estate. Effects, try it on your own. Don't be bashful. Type in a number. Justin, you have a number for the first year?
Get it by?
Yeah. Oh, and Kyle, you might have said, when was it purchased, not meaning was this year, but I apologize. Maybe you even had a more specific question. And do you have a favorite month? Selena,
Yes.
do you have a favorite month?
Month of March.
It was purchased in March for the exam. You should be able to get this. And by now, Nellie, you have a number? 200, you say. Justin, David, Kyle, say it loudly.
I have 100.
Numbers. Take the 1,000, right? Year one. And we times it by what?
1/2.
1/2. Did you do that at your convention?
2/5.
Times 1/5 times 2 because it's double declining, right? So, if I do my math right, isn't it just 1/5 of 1,000 is 200? All right, be careful. I want this to be a happy Thanksgiving for everyone. 100, Justin, you would not be happy with yourself.
Double decline, you just multiply it by 2, because before I remember doing like 2/5 instead of 1/5.
All right, it doesn't matter. Same outcome.
Yeah, it's the same.
All right, guys, year two, give me a number. Don't say it out loud. Do not say it out loud. Give me a number. Year two. Justin, you're great. Nellie? That number? Right? Because it's double declining. Sometimes people forget. It's 800 times 2/5, right? This keeps going until straight line method becomes greater than declining. So you keep taking depreciation deductions. And of course, what do depreciation deductions yield? Result in lower tax basis, right? Everyone agree? Section 1016. Pointed out that this could all lead to recapture income, right? Because these are very, very, very generous depreciation deductions. So, for example, you buy that new piece of equipment, and you deduct a full 1,000, right? Years later, you sell the equipment; it's still pretty valuable, say for $400. What kind of income is that? 45, all ordinary income, right? That realize is 400. The adjusted basis is 0. Gain is 400. Code section 1001. Character, all ordinary because it's all recaptured because you had previously taken a deduction of 1,000, right? And if I asked you the question if it were sold for 1,100 because there's a shortage of this machinery, how much? Question, guys. How much? We bought it for 1,000, expensed it. 3 years later, sell it for 1,100. It's all in year one. Our basis is 0, right? So how much gain? Gain is 1,100. What's the character? You say, right? We're patient. You want to say 1,000, 1,245 gain, 100, 1,231 gain. Which we have to see if the gain exceeds the losses, the losses exceed the gains, right? Patience will serve you well. Not that everyone can handle that. Listening.
Confusing the way that they go out, like when the straight line is greater than the double declining, we apply mid when it goes out because you said the last year is as the first year.
What do you want to do?
How do I'm just confused. Like 192, the next year would be 192 is less than 200. If we do,
In this problem,
yeah, this problem if we do,
figure it out. So I really can't tell you. It's 480, right? It's 2/5.
okay, that's 192.
192.
Less than 100, that would be the 5-year depreciation.
No. You got to do straight line over the remaining term. There's still, if you look at this, there's years 4, 5, and 6, right? There's still 2.5 years. So you apply straight line over the remaining 2.5 years.
Or how do I know that I have to apply straight?
It's trial and error, but truth be told, the computer does it for you. I'm just pointing it out to you that that's how you would do it normally. Whichever one produces the more depreciation. I mean, you could test it because it's either, the next year is, take 192 out of 480. How much is that? So it's 288 fifths equals how much? Someone help me out there?
150.
What would be straight line? Remember, this is year 4, 5, and we go to year 6, right? Because we know in year 6 it's the remaining half, right? So we have 2.5 years, and we have an adjusted basis of 288, right? Year, 2.5 years, right? 88. It's 115. So that means we stick with double declining. It's in year 5 that it's going to produce a higher result.
In year 5, it's 1 over 1.
Again, if you don't know depreciation, I'm saying this in a beloved way, you got to know it because you'll see several questions on the exam. All right, so I'm not mincing words. No one should feel, oh my God, I can't believe he asked a depreciation question. I'm totally surprised by that. That's really unfair on his part. So my message to you is a very simple one. Know it, and then that's going to be easy points for you. And there's not going to be, there's not much I can do to, and I'm not looking to do this, to complicate the question. What's the depreciation in year 1? What's the depreciation in year 2? Use the right conventions, and that's like done. Just saw it. But if you're not getting it, and you're, for whatever reason, you're not going to, I understand in your pressure, you don't want to say anything, reach out to me and explain why you're not getting it, okay? So we went through the problems. Those problems found on page 426. And we were talking about, or about to talk about, rules pertaining to depreciation of real property. I was going to go through some examples. Now, before I go on, that sort of summarizes where we are. Any questions about material we've covered, logistics, or other things? Go ahead, Kyle.
Oh yeah, I just have a question for full month conventions.
Shoot.
So, and like December is 11 over 12.
Oh, say again, when do they put it into service? And it's 1 over 12.
Oh, my bad, 1 over 12. So, January would be 11 over 12.
12 over 12. Year.
Oh, okay.
Right? Advertised generally under what code section, guys? Section? 7, right? 197 over what time period? Intangibles are amortizable over what time period, guys? 15 years, right? This is just some very quick logistics, and then we'll do some real estate questions. Keep in mind that, if I'm not mistaken, hard to believe what I'm about to say. Next week is our last full week. Is that a fair statement? We have class on Monday and Tuesday of next week. And we have class the following Monday, and then our exam, I guess, is 2 weeks from today, right? Bear that in mind, that you guys have a lot of exams between now and then. Well, then your calendar frees up for my exam. Is that the story?
Well, yours is right after the accounting.
Yeah. All right. Well, just do bear that in mind. I will say, again, if some of you are coming Saturday, that's great. If you can't because you're working, completely understand. Or if you're studying tax, I completely understand. Anything other, I'm not sure if I understand, but I'm sure I do understand. And then I think some of you did go online and were humored by some of the comments. I think, Wendy, you were saying some people that the two, I never have 2 ops eds in 1 week. This is a strange week in my life, but if you want to be humored. Guys? All right, then let's look at the questions on page 431. you know, with real estate, it's straight line mid-month, okay? Everyone understand? Straight line mid-month. You know, the recovery periods, the code specifies it. Residential rental property is 27.5. For commercial property, it's 39 years, right? 431 says depreciator purchases a piece of new improved real estate at a cost of 130, of which 100,000 attributable to the building and 30 to the land. And we know, everyone in this room knows the land is not depreciable, right? Right. Depreciator immediately rents the property to other. Complete depreciator deduction in the subsequent year, not the first year, but the second year. But you know what, guys, don't get mad at me, but I feel comfortable among friends to say to you, I feel comfortable asking you what would be the depreciation in the first year, Kyle. So I would specify, hey, the property's purchased, say, in October. Well, let's make it November because your exam will be in November. So let's just say real estate is purchased this piece of property in November. Depreciation in the first and second year, guys. If it's an apartment building, okay, residential apartment building, or question B, an office building. So let's do the apartment building first. Give me the first and second year of depreciation, please.
Asset, 39 years.
I don't want to say because you should be able to look it up. So just look it up because that one I don't have to give you is right there in the code. Point out where you can find it. Code section 168C.
27.5.
Yep. Depreciation. It was purchased November 2019. What is the depreciation in November? What is it in 2020? What is it in 2019? What is it in 2020? My numbers are a little bit numerically off. It's 100,000, right? Times what?
Oh, I actually did 99,000. I subtracted the first year.
No, that's why my number and your number's off. It's not double declining, guys. What's the number? $3,636, right? Hey, Justin, good to make it today. Don't make it on the exam. Don't make it with a client.
We'll decline it. Subtract the subsequent.
Or 150% double declining. Now that you did that, do the office building. Quickly do it. Let's just get it done. Numbers, right? Kyle, what do you have for 2019? What number?
320.
20?
Yep.
What did you do?
100,000 times 1 over
Kyle, what did you have?
at 2,564.
Everyone got that? Everyone can handle that for exam purposes? Question 1C is kind of a throwaway. We're not going to ask you any anti-churning questions, so don't worry about it. B, suppose depreciator elects to use the alternate depreciation system with respect to buildings in A and B above. What would be the 2020 depreciation if they, remember, code section 168G, you can elect to use the alternate depreciation system. If you did, what happens to the depreciation deduction? We use, in the case of residential property, 30 years, right? See that? Where it says 30 years? Non-residential, 40. I don't need to do this for you guys. You can multiply it out for yourself. In the case of 30 years, it would be $3,333. In the case of 40 years, it would be $2,500, right, in 2020. We got those numbers? First answer would be 3,333. The second would be 2,500. Me, I wouldn't worry about because the law is undecided. It talks about so-called qualified improvements, but there's ambiguity about over how many years qualified improvements can be depreciated over. So that's going to be resolved in a future income tax class, guys. Question F, how about $100,000 is spent to rehabilitate the internal structural framework of buildings in A and B, certified historic structures built in 1940. Let me just call this for attention. You know, sometimes, right, guys, Internal Revenue Code, for public policy reasons, wants to spur people to do certain things. And in this case, there's a certain credit available with respect to certified historical structures that you get a 20% credit for expenditures. What's my authority for that? Check out Code Section 47A2. I repeat, 47A2. You get a 20% credit. Well, 20% credit, if you spend $100,000, how much is that credit worth? You can do the arithmetic. 20% of 100,000 is 20,000, right? You can use that credit over 5 years, or $4,000 per year. I repeat. By the way, guys, it's spelled out. Let's do a little bit of a blurb on on page 430, the second full paragraph. 20% credit on certified historical structure. What happens to your tax basis? Well, if you spend $100,000 and Congress is going to give you a $20,000 credit, how much do you think you can deduct, guys? Going forward, right? Because doesn't that $80,000 represent your real after-tax investment in that building? So Code Section 50C1, I'll repeat. Code Section 50C1, the basis is $80,000. So your basis is $80,000. You need to know, is it residential or is it commercial? Depending on what it was, every year you get a depreciation deduction, except for the first year, it would be the mid-month convention, and the last year, it would be likewise, whatever the mid-month is. Let me just make the point. You know how we put property service in November? Picture, if you will. Suppose we held on to that property, we kept depreciating it, and it was commercial property. Depreciation would we be allowed? In the first, in problem 1, it was problem B. Picture, if you will, there's this $100,000, and now the last year, depreciation, what do we get the last year? If it was year 39, so it's 20, excuse me, we're depreciating it, so it's got to be 40 years from now. It's scary, guys, 2059, okay? A little bit older and wiser, right, guys? Year 2059, how much depreciation will we get? The numerator and denominator. 1,000, right? Times 10.5 over 12 times 1 over 39, right? Because it's presumed we put the property in service in November and we hold it for the duration, it's presumed that it goes out of service. Over, right? For the following. In this case, I'm just using it would be 80,000 if we were going back to this problem. You're right.
Okay.
All right, I'm just talking about the generic problem before. Understand that, right? Just like with the mid-quarter convention, it depends on when you purchase it, right? The asset, and then if you sell it, or the final year, whatever you did in the beginning, it's the exact opposite in the year of sale, or the last year. It's you're entitled to a depreciation deduction. Needless to say, guys, you can hold property longer than the useful life, right? Often that's the case. You just won't get any further depreciation deductions, right?
This is the year 2059. You sold it in May.
In May, then you would just use 0.5, 1.5, 2.5, 3.5, 5.5 over 12. Depreciation.
So to confirm, that's the depreciation equation for the last year, the sale year.
Sale year or the final year, you're still using it, you still own the building, And that will get you a complete $100,000 of depreciation deduction. Taking into account the first year, right, you only got a measly small depreciation deduction. Right, I believe numerically, you take 2,564 minus 320, that should give you the last year of depreciation. Questions, guys? We're coming to a close on, I know it's kind of bittersweet, on chapter 14, which we've spent quite a bit of time, but I put my practitioner hat on, guys. A lot of clients want to know all about deductions, right? You got to know your deductions inside and out. Anticipate correspondingly for exam questions that we could get a lot of questions regarding deductions, right? 15. Moving on. You may want to keep open section 212. The theory that you guys had an exam today, so I'm not so sure that you were able to read for today's class. So under that notion, you'll hear my monologue, but if you did have a chance to read and you want to talk about any particular case, be my guest. All right, so I'm not trying to impede any conversation. I just want to share with you that if you haven't prepared, so be it. Rather have you here than not. So code section 212, the authors start off with the Higgins case on page 433. Mr. Higgins, sounds like he's coming straight from the show My Fair Lady, right? Mr. Higgins, a lot of time, effort, and energy on his investments, right? If you had a chance to read this, he was like a day trader of yesteryear, right? He hired people to figure out, he didn't have the internet back then, right? So he devoted a lot of time to, and people and offices, all for the purposes of trying to get great returns on his investments. The question was, could he get deductions for the expenditures he made? Both the Board of Tax Appeals, which is the predecessor to today's tax court, and the appeals court says, if you had a guess, yes or no?
Why he's appealing?
All right. Both the lower court said no, not deductible. Not deductible. Why? What kind of expenses were these considered to be? Not deductible. Personal expenses. Taxpayer win or lose in we're all the way up at the Supreme Court. You could either be under Code Section 162 or 212. And the IRS had a pretty compelling argument that the taxpayer is not involved in a traditional trade or business, right? Not in a business of making investments, right? Not deductible. Not happy with that outcome because Congress's opinion is, hey, just like with business expenses, if you spend money to make money, right? Because if the taxpayer makes money, who also makes money? Uncle Sam. Did I share with you? My brain is always, it's maybe too fixated on tax, but that's okay. Do it for a profession. So, stop me if I told you this, but over Parents' Weekend, I was cornered by someone who got into a discussion, and the thrust of the discussion, and we'll see what you guys think, talking about my mantra is, hey, Republicans want to cut taxes, they have to cut spending. Democrats want to increase social spending, they got to raise taxes. That there's no free lunch, and that should be everyone's agenda if you're true to your word. So he turned to me, in a manner, or parry manner, however you want to phrase it. Said, oh, okay, Solid, if you think there should be more social spending, why don't you just voluntarily pay more in taxes? Now, my response to you is that a valid approach? If someone says to you, okay, you think there should be greater social spending, just pay more in taxes. Your gut reaction is that sounds stupid, right? Once you say that, though, can you back it up? Can you articulate the reason? That is challenging. I didn't sit there and say, "Oh, for the following three reasons, you make no sense." So I had to spend the last 2 or 3 days sitting behind my computer and thinking really hard on counter arguments to that. So that's what my next little vignette is on. I write lots of other things too, but this was challenging. Do you guys have any opinion on that? To you? Well, I think some people should pay higher taxes, right? Many of you, even the conservatives in this room, probably say, well, Bill Gates should pay higher taxes. Okay, if you think Bill Gates should, why don't you?
That people voluntarily pay. They try to avoid as much as
To avoid, but if you think it's a good thing, shouldn't you pay more? Sure, you guys now are at the edge of your seat saying, oh, I want to read what Solid has in mind. For, if you do, I'm working on this. It's a work in process.
Well, we had in Ecuador a situation 2 years ago, well, a couple of years ago.
Are you from Ecuador?
Yes.
Ecuador.
Have you been there?
Greatest museum, the Earth Museum, because it's right on the equator.
Yes.
If you go to the museum, they have all these neat kind of things because if you're in the northern hemisphere, your water goes in one direction. If you're in the southern hemisphere, your water goes down the drain in the other direction. And when you're right over the equator, it doesn't spin; it just goes straight down. And it's much easier, as Nellie will tell you, to balance an egg right on the equator. You can easily balance an egg. And they do all these other kind of tricky things where they lock your arms, and if you're 1 foot over, you can easily break the lock, but if you're right on the equator, much harder to break that lock. And it was in the Galapagos Islands, which are also spectacular. Now, keep going.
Going back to taxes, Correa, the last president, the previous president, he put it on import tax.
It's more like a customs duty as opposed to a tax.
Okay. People were unhappy of that because use as much quality as we import. But my thinking was that will improve the economy, like paying higher for Florida oranges. It's good because we have our own oranges, so it
Makes it more attractive.
yes. But what happened in our country and what we are pissed off is that those taxes that we pay for outside, like they weren't properly managed, and now we didn't develop our economy. So, in my opinion, bias to my country. I don't know if this happens here in a global manner or if it's just there. Like we pay taxes and we would happily pay more taxes, not going where we wanted to go.
It's a different issue. I hear you. Anyway, if you're curious, I'm more than happy to share my tentative thoughts on a reprisal to that argument. All right. So Higgins. These are disallowed. Congress comes back and says, this is not going to work for us. And writes Code Section 212. Section 212. In the case of an individual, though not a corporate taxpayer, an individual taxpayer, there should be allowed as a deduction all the ordinary and necessary expenses. Sound familiar, guys? Ordinary and necessary. During the taxable year for the production or collection of income, for the management, conservation, or maintenance of property held for the production of income, or in connection with the determination, collection, or refund of any tax. In the door, because in my world, your world, the philosophy was, hey, taxpayers spend money not on a trade or business, but this time for investments, and they make more money. The government's a benefactor of that, right? So everyone see the framework here. Bowers v. Lumpkin case. Bowers v. Lumpkin. Under Bowers v. Lumpkin, taxpayer from from a charity. She purchased stock from a charity. And then the Attorney General of South Carolina instituted a lawsuit to invalidate the sale. Incurred thousands and thousands of dollars of litigation fees in her investment. To deduct the cost of the litigation, the auspices of Code Section 212. I'm spending money for investment purposes to protect my investment. A lot of money given the year. And by the way, if you're looking at the code section numbers, they obviously don't correspond because it predates the 1954 code. Okay, so you guys should be experts at this stage of your tax career. This is a predecessor to the 1954 code. The thousands of dollars she expends, can it be deductible under Code Section 212? I just call your attention to Regulation 212-1K. Open it up. 212-1K. Expenses paid or incurred in defending or perfecting title to property, and recovering property, or developing or improving property constitute part of the cost of the property and are not deductible. To say, attorney's fees paid in the suit to quiet title to lands are not deductible, and it goes on from there. What do you do with the costs that you incur to secure good title to property, guys? Again?
Capitalize it.
Capitalize it, which means what in a practical sense? You add it to your tax basis, right?
Quiet a title to land.
That means that you secure good ownership, that no one's going to challenge your ownership. You quiet controversy around you. So when you get to the end of this case, who prevails? Right? The taxpayer has to capitalize to read, and particularly not a hard case in the year 2019. I step on anyone's toes. If you had a chance to read it and you want to talk about it, great. If not, I don't want to put anyone on the spot. I'm just appreciative that you guys are here. People on tape or WebEx, and my philosophy is people generally do better on exams by physical presence, okay? WebEx, second best, third best is listening to tape, fourth best is not doing any of the above. Maybe a misnomer in that context. Any volunteers? You want me to run with the ball? All right, so here we have a taxpayer. Taxpayer loses district court level. Why does the taxpayer lose? Because the taxpayer spends a lot of money. Makes an investment, purchases stock, and then once purchasing the stock, spends money to try to get directors and things like that, okay? So you have a taxpayer who's spending money once they own stock, get a new management team, get a new board of directors, trying to change how the whole company is oriented. The question is, or hold an investment in stock, and now you're trying to improve the company by spending money. Not a trade or business, it's an investment, obviously. Those expenses to improve the company. And on page 442, the whole paragraph talks about the taxpayer was not 100% successful. But his vision of this company, vis-a-vis his investment, but it was partially successful. The second paragraph on page 442 points out that as a result of his activities, he really was able to make money. But the taxpayer loses at the district court level. Why? Look, if you look again at the regulations under 212-1D. Okay, so go back to the regulations under 212. Look at 1D. We're going to have that? Let me read it out loud. expenses to be deductible under Code Section 212 must be quote unquote ordinary and necessary. Thus, the expenses must be reasonable in amount and must bear a reasonable and, you may want to circle the next word, proximate. Everyone see that word proximate? Proximate relation to the production or collection of income, or to the management, conservation, or maintenance of property held for the production of income. Drew the court's attention at the lower level was this word proximate. And they said, look, this taxpayer was spending a lot of money to try to improve the financial solvency of the company he invested in, but it was speculative. There was not a really, at least in the lower court's mind, there wasn't a clear connection between the expenditure of money and its improvement. So the lower court labeled it speculative and said this proximate relationship was missing, and therefore ruled against the taxpayer. The appeals court says, you know what? It wasn't so speculative. There was rationale, expenditure, and the company approved, and therefore we think it is deductible. And the court said, think about it, the word proximate, and you guys may have picked this up in your business law class, where does the word proximate come from? It's often used in the tort context, right? Is there a proximate relationship between the accident and the resulting damage? Not really a term of art you see much in tax. So the court thought, hey, this regulation is kind of awkward, and there does seem to be a real connection between the taxpayer's expenditure and the production of more income, and that's exactly what Code Section 212 is all about, right? Permitting taxpayers who make expenditures to improve their investment to secure a deduction. Parenthetically, limited by Code Section 263, right? That we saw in the Bowers case that sometimes you have to capitalize those expenditures. 162 is sometimes limited by Code Section 263. Similarly, Code Section 212, limited by Code Section 260. Sometimes 212 is limited by Code Section 274. There are some, like if you go on a cruise, I forget if the authors asked this question, but if you go on a cruise to learn more about your investments, okay, can you take a deduction, right? You're spending money, right, to learn how to better invest, right? A deduction if you go on a cruise to learn about investments, guys. What do you think your answer is going to be?
Yes.
Yes and no. And oh, no, you may not, but I know in Code Section 274, because I want to find it for you, there's a limitation that says that if you go on some sort of trip to learn about investments, there it is, 274, H7. Entitled Seminars, etc. for Section 212 purposes. No deduction shall be allowed under Code Section 212 for expenses allocable to a convention, seminar, or similar meeting. Companies were doing, having all these fancy trips to Hawaii, cruise lines, all that, and at the bulk, what do you call the bottom of a ship? The hull. They would have some seminar tapes running on what to invest in. This way, taxpayers could say, "Look, this is a 212 expense. My $10,000 that I spent on going on this cruise should be deductible." It's all pertaining to how to invest. Congress thought that was not a good idea, right? Because you're going to open the door for any justification for a deduction. So I'm just pointing out, like a lot of tax, once you get one thing, it's a lot easier to get other things, right? There's real economies of scale here, and I always found that very enticing about tax, that the more you know, the better you get.
Sometimes they take us to a convention, it's not deductible.
investment purposes or for business purposes? That's okay, as long as it's not overseas. It depends if it's in the North American area, and even if it's overseas, maybe there's a justification for why it's overseas. But for it to be deductible and to be for overseas, there has to be a real connection between the rationale. Why are you having this convention in Monaco? The IRS threw in the flag on this issue. If you look at Revenue Ruling 64-236, the proxy fights, right? If you spend money, wage a proxy fight. You're doing it because you are doing it in aspirations that your investment is going to be more productive. That will be deductible. Okay, that second paragraph on page, or Revenue Ruling 64-236 on page 446. The proxy fight expenditures are deductible under 212 if such expenditures are approximately related to either the production or collection of income, the management, conservation, or maintenance of property held for the production. I don't want to talk about it. I feel like the microphone up here. And your reticence says, go for it, but just an abundance of caution. This case is about Fleischman, physician in Cincinnati. He and his wife entered into a prenuptial agreement, and the divorce, he would pay his ex-spouse, we're all sitting down for this number, a whopping $5,000. I know it's many, many years ago, but even many, many years ago, guys, 5,000 was not big bucks, okay? Was this the happiest of marriages? In 1955, how many years were they married? Of course, in 1961, right? The wife files a suit to invalidate a prenuptial agreement. Easy or hard to prevail, to negate a prenuptial agreement? Okay? Not easy. Although, if you want to up your chances, and some of my wife, before she started teaching, was a matrimonial attorney, and I deal with a lot of matrimonial attorneys. You don't want to be in a situation with a prenuptial agreement where people are signing before at the cocktail hour before the wedding. That is what we call undue duress. Then you can invalidate, right? Because if it's not signed, what are you going to say to the guests? Sorry, go home. So you can picture, but people do this. I know that sounds crazy, but people are known to say to their lawyers, meet us at the wedding, we'll sign there. Not on my watch, but I know other people, and this has happened. And then if the marriage goes south, you have good grounds to invalidate it, right? Incredible what sometimes, just a week ago, someone who's worth north of $10 million sent an email to me and said he and his wife-to-be, I should say, worked out the terms of their prenuptial agreement, and he found a good one on the internet. Would I mind reviewing it? And if I thought it was okay, they would sign off on it. How it's done. But anyway, what people sign off on, and they get themselves into more trouble after the fact. Anyway, that issue aside, he's going to lose, okay? But he spends a lot of money defeating her, okay? He spends a lot of money defeating his soon-to-be ex, and he wants to deduct the legal fees associated with the divorce. Now, if you look at Code Section 212, and even if you didn't read the case, what do you think his authority? On what grounds would you like to? What would he invoke for deductibility here, guys? Lady Dr. Fleischman here. How would you secure a deduction? It's going to go under 162, right? It's not a trade or business. How are you gonna shoehorn this in, possibly as a deduction? What section?
212.
2, right? 212.2. And it's not going to be under, right, because spending money to produce income, everyone agree? So it has nothing to do with 212.1. Nothing to do with code section 212.3. Because that deals with tax issues, right? For tax advice, it could fall within the scope of code section 212.3. Show of hands, just for my entertainment. And hold on, someone may be asking a question on WebEx. Okay, who do you think wins? Is it the taxpayer? IRS. Anyone say the taxpayer wins? Wins, you can't fence it. Why do you say the IRS wins? Section would the IRS invoke? You had your hand up, the IRS. What code section do you think it might invoke?
Is it a regulation?
Section 262, right? Say, look, this is a personal expense, non-deductible personal expense. And he's saying, no, it's a 212 expense, right? At least until last year, if you're, and I'm gonna make this a male-female thing, where the wife looks for alimony, spends money to secure alimony, and spends $40,000 in legal fees to secure alimony, deductible or not? And if so, what's your authority? 12.1, right? Used to be, and I'm going to say this used to be, 12.1, it was deductible, right? Excuse me, let me rephrase that. The husband could deduct the alimony, and the wife had to include it. So that's for the production of income. Section 215. Used to be you could deduct it, and the wife who fought for alimony had to include it, but any money she spent to secure the alimony was deductible. I trust myself, but not that much. But you guys may think otherwise. I now know that there was a code section where it's going to say the same thing, which I want to find, but I'm not going to find that quickly. Where would I look to say it's now excludable from the wife's income? Right? He could deduct it, she had to include it. Deduct it, now it's going to be excluded. What code section? Where would I look? Now, I'm not going to find it as readily as I want. Where would I begin to look for alimony payments being excluded, guys?
101 had to do with death benefits.
No. I said starting on 101 deals with all sorts of exclusions. So all code section 71 is, code section 71 talks about items specifically included in gross income. So there should be now a provision that says, right, when the wife gets paid alimony, in my example, we need a provision that specifically excludes it from income. 71 is no longer relevant, right? You really, after class, I got to find out what code section excludes it from income. 215 isn't going to deal with that because that deals with what is no longer good law. Code section 215 and code section 71 were repealed in the 2017 Act. Getting back to Dr. Fleischman, here's my point here. And again, this could go for palimony too. If the husband or wife, whoever fought for alimony or palimony, could take a deduction, right? Because they were fighting for monies that would be included in their income. Under code section 212.1, they could take a deduction. But beginning in the year 2019, can they take a deduction anymore? No. Now, if you get tax advice, your legal bill, courses do not come cheaply, right? So if your legal bill is $100,000, You might say, come on, you're exaggerating. No, no. If anything, a lot of divorces I've seen cost $200,000-300,000. So if the legal bill happens to be at the low end, 100,000, and 10,000 is for tax advice, be deductible under Code Section 212.3. So you need to have an itemized bill. So if the IRS audits, you can say, look, 10 hours were spent on tax advice, and therefore I can deduct $10,000, right? You will no longer be able to deduct money spent for alimony. Dr. Fleischman's argument that he's spending money to conserve or preserve his estate. Like, suppose the doctor, make up a number, was worth $2 million, and the wife said, look, I want $1 million of his $2 million. The prenuptial agreement is invalid. On the face of it, Code Section 212.1 might work, right? Because he's trying to preserve the full $2 million. Everyone agree? Doesn't our taxpayer look like they're trying to preserve property, and that's the benchmark for deductibility? The IRS say, it says, look, case that the IRS relies upon called Gilmore. And when you look at a filed complaint, look at a complaint that's filed, you look at what's called the origin of the complaint. The taxpayer to file the complaint. And the taxpayer filed this divorce complaint. File it as a mechanism to preserve his property, or did he file it because he hated his ex-wife? What was really the driving force, guys? Laughing.
I was thinking maybe she hated him.
She hated him, he hated her. Let's put it this way, there's no love anymore, right? Notwithstanding the wedding date and their vows of true love forevermore, it just didn't pan out, right? Having said that, more cases, look at the origin. And what was the origin of the divorce? It was really personal in nature, right? Or she wanted out. And he wanted to conserve his property, but let's face it, is that a secondary concern, or was his first and primary interest, he didn't want this woman anymore and she didn't want this man anymore? It was a non-deductible personal expense, right? When you cut to the chase. And that makes sense, right, guys? Because you can almost try to shoehorn any kind of expenditure in, saying, look, I just spent that money to preserve my wealth. And that's not how this is supposed to operate. Right? So the taxpayer loses here. Look at the Gilmore case that the authors cited to. Ready to do the questions on page 454? Speculator buys 100 shares of Sound Company for $3,000. Favor broker commissions $50 on the purchase. 14 months later, she sells the shares for $4,000, paying a commission of $60. All right, guys, compute. Let's put it this way: are the commissions 212 expenses? What do you think? Can you deduct them? The commission expenses? Oh.
Yes.
So when you buy the property, can you deduct them that year? Capitalize them under Code Section 212.1K-1K? Yeah. So
Expenses will be capitalized.
have to be capitalized, just like you said before, Kyle, on the basis. So guys, this should bring us down memory lane. Everyone feeling comfortable going down memory lane? Hand in hand? All right. What code section, when you hear the word sale, do you think of? Right? 1001. 1001. What is the asset that we're selling here? What is its nature? Capital or non-capital? Capital, right? So compute the gain or loss. Everyone come up with a number. To be the number guy today. What do you have here? A wide variety here. Wendy?
Yeah, sorry, add the commission.
Her basis is $3,050, right? What's the amount realized on the sale? How'd you get that? What's the amount realized?
It's 4,500 minus the 45, which is 55.
Yep.
And then the 3,050.
Loss allowed? Allows the loss? Natalie?
165.
165. It should be. It was entered into for profit. What's the nature of the loss, Justin? What's the character? Capital? What code section do you want to think about at least? Right? The capital loss limitation rules, right? Right? You got to see if this was a $5,000 loss rate, we might be capped at 3,000, right? And have to carry it forward under code section 1212.
The 595, and then we went to section 165C2.
It was allowable. Code section 165 allows losses, right? If it's entered into for profit. Code section 1211 sometimes limits the amount of capital losses, right? C, what results in C above if speculator owned 10% of the total outstanding sound company stock worth $300,000? Oops, question C. Speculator owned 1/10 of 1% of sound company worth $3,000. Being an eager investor during the time she owned the stock, she incurred $500 in transportation, meals, and lodging, traveling 1,000 miles to New York City to attend a sound annual shareholder meeting. May she deduct the cost under section 212(2). David, what do you think? Deductible or not? It is. Kyle, agree? Why? Give us a rationale.
I think it falls under any of the 212.
Troubled, or are you saying it's deductible or not?
No, I was saying.
Very necessary. Does this look speculative? By the way, some of you, for example, if you, in yesteryear, if you own one share of Disney, you could stay at Disney and you get a discount, right? You could be entitled to a board meeting, right? So picture, David, might your answer change if you own one share of Disney and you live in New Jersey and you go down to attend a board meeting because you, listen, you want your one share to improve in value, and your one share, I don't know what Disney's trading at these days, $100. You spend $1,000, go to Disney, to the shareholders meeting. You're gonna let a deduction?
I misread the question. I thought she owns a lot more than
So, again, it's got to be ordinary and necessary, and this truly looks too speculative. Probably not deductible. What, Jervon, you said it before. What code section would probably apply here? Right? Personal expense, right? The facts, suppose you own 10%. You're more comfortable now? More likely to be deductible under code section 12.1, right?
Could be different if, say, the company owned like 60%.
I don't know what you mean, the
Wouldn't
company
really
owned.
matter, I guess.
I apologize. Just what do you mean the company owned?
Called a sound company.
Right.
They own like 60% of their own stock.
But company can't own its own stock.
Oh.
It just, you got to give me a plausible fact pattern and I can respond, but I can't respond to something that doesn't make sense.
The amount's like not material for, like, what if 10% of that investment?
Need to know more facts. Yes. Question 2, after reading the Fleischman case, consider what situation made the payor spouse deduct attorney's fees in getting divorced. He says, what payee expenses may deduct attorney's fees in getting a divorce. This has been changed because you're not going to be able to get a deduction under 212.1 anymore because it doesn't result in the production taxable income. Everyone agree? Does not result in the production taxable income. Under Fleischman, it's virtually impossible to argue that you're trying to conserve or preserve your property. Deductions, the payor or payee spouse is going to be entitled to, in my opinion, fall within the scope of tax advice, right? And that's going to be very, very limited under 212.3. So, see much in the way under 212.1 or 2 anymore. Just spend because a few minutes talking about the things you might want to consider. Then I want to just talk to you about the next chapter. We'll finish up on Monday this chapter, but I think it's not a bad thing. Hopefully that more people will be here on Monday, and then hopefully they'll absorb more if I don't finish. At least that's my aspirations. But let me give you some things that I hope will make your life easier for what we're about to embark on. So let me just say this, not going to come as a surprise, that if you have personal use property, suppose you have a house and you bought it for, say, $1 million, just to use a number, or a car. You're not going to buy a car for $1 million, but say for $100,000, it's a fancy car. And at some point, you convert it to business use. Depreciation purposes, what do you think will be the number you use for depreciation? The lesser of what you paid for it for its fair market value. So, for example, if you all of a sudden decide, you know what, I'm not going to live in my house anymore. I'm going to put it on Airbnb. It's in the Hamptons. It's now worth $800,000. The year you place it in service, it's worth $800,000. That's going to be your go-to number for depreciation purposes, not $1 million, right? Because your personal use caused the property to decline from $1 million down to $800,000, right? Bring that to your attention. That the property declined by $200,000. That being the case, when you convert property from business use to personal use, and you're going to see that, by the way, in the regulations. 160, the authors on page 455, all this to your attention. 167G-1. So, next class, I want you to go through chapter 15. We're going to definitely finish, no ifs, buts, or maybes. But then, keep in mind, we're going to move on. Our final leg is chapter 19. Now, let me just spend a few minutes and try to make your life easier over the weekend. Hopefully, if you spend time doing this. Chapter 19, guys, I want to call to your attention how it's organized, because I hope that if you can see this chapter for what it is, life a lot easier. Chapter 19 begins on page 587. A four-letter word. A four-letter word. Four-letter word is?
Time.
Time. Or when. Instead of in chapter 12, we dealt with the issue of who. Now we're dealing with the issue of when. And the authors give you an introduction on the first few pages. And that introduction. Then beginning on page 591. They start with the cash disbursements method. So half this chapter, okay, chapter 19, deals with the cash method. And notice right under receipts and disbursements method, you have the word receipts. Receipts means inclusion. When or an income. If you look on page 605, they have disbursements. Are things deductible? And how do you think this plays out? Does the IRS want inclusion later or earlier, guys? There is general philosophy. Inclusion later or earlier. Right? Defer income, right? The IRS want inclusion. P, right? So notice the tension. Taxpayers want to defer, IRS wants. With respect to deductions, when do taxpayers want deductions? B. When does the IRS think deductions should be had? Later. Page 618. We're going to move to the accrual method. In the accrual method on page 618, there's income items, and shockingly or not so shockingly, on page 634, there are deduction items. Everyone see that? Which method is more accurate, cash or accrual, guys? Which one is more accurate? Right? More accurate. As a concession to taxpayers who are not that sophisticated, code permits the cash method, but sometimes you can't use the cash method. For your purposes, when you look at chapter 19, in terms of reading for next class, we're going to finish chapter 15, which will not take us that long. And then you don't have to finish the entirety of chapter 19. Look strictly at the cash method, okay? So for your reading for next class, you will indulge on the cash method. Do bear in mind, for exam purposes, and I'll repeat, but you get the first go around here. Pivotal to your success. This is why you might choose to bring a red pen, marker, whatever works for you guys, is Solid asking a question about a cash method taxpayer or accrual method. So that's key, because if you put it in the wrong quadrant, you might as well take out a coin from your pocket and start flipping, right? But if you get the right quadrant, you're on the path to glory. So am I talking about the cash method or accrual method? And I know you might say, well, who needs a red pen? Who needs a yellow marker? I kid you not, under the exam pressure, you may overlook that, or you may not see it. So look for that. And then, I know this sounds again, like who would ever miss it? I know people miss it. Is he asking a question about inclusion or deduction? Again, for exam purposes, these make for easy multiple choice questions. What year does the taxpayer have to include it? What year does the taxpayer get a deduction? Seems simple enough, but you're going to see we're going to have general rules. You guys have been down this path before. We're going to have exceptions. What we're going to do is fill this in. We're going to talk about the general rules on Monday, and we're going to start talking about the exceptions so that we're going to fill in this four-part quadrant utilizing, chapter 19 as our framework. So that's where we're going to go. Any questions on the material, guys? What we're doing? All right, so I will hopefully see you guys and hopefully a lot of other people on Monday. Coming. Thanks for listening on WebEx. So